Hello, everybody, and welcome to the Brain Trust here. We have 5 of the more prominent sports bankers and sports investors in our industry. And guys, we're going to have a nice free-flowing conversation. So I'll say this and then I'll get out of the way. I feel like from my position writing about deals in this industry, it feels like we're in this period of unprecedented volume. Right as the pandemic hit, things were kind of a lull. And then the last 12 months or so, it feels like we've seen more LP transactions, more private equity deals, more majority stakes, more debt financing than we have in this short a period in a long time. I'm curious if you guys think, is this the new normal for your world, or is this kind of a temporary pandemic related thing that will kind of go back to relative, back to the levels we were seeing in 2019 at some point soon?
Look, I do think that the pandemic did highlight the fact that just overall, it is difficult for a lot of teams to raise capital. And in the pandemic, there were a lot of teams that immediately needed to raise funds in order to support the business. At the same time, there had been new investment funds like Arctos that had been raised that were looking at opportunities. And I think leagues that had previously been reticent to allow third party or outside capital into teams, they all of a sudden decided to open their doors more to that. I don't think that that's going to change anytime soon. I think if anything, you're going to start to see more institutional capital coming to teams over time. So from a broad perspective, I do think that it's going to lead to an accelerated deal activity over the coming years.
Yeah, I guess my asterisk to that, Mike, would be, I think you're right. I think for LP minority non-controlling stakes, we have a new marketplace that's in its infancy, actually, with Arctos and others coming in. And I think there'll be more that come in because wealthy families and individuals and institutions want to play in sports, want to invest in sports without necessarily owning and operating a team. So I think that activity will continue to increase. I'm not sure that we're not going to see the typical deal flow in terms of majority sales and full team sales going forward. I think there was some pent up demand for teams during the pandemic, and there were some owners that were sort of sitting, waiting to get through it to sell. I think we'll see 2022 will be an active year in terms of full sales, but I think it typically reverts to the norm over time. Nobody really wants to sell a team unless there's either a family transaction, divorce, death, or some other disruption in the family, or a financial setback. Otherwise, I think most people who own major league teams kind of like it, and they've become more and more multi-generational over time.
Yeah, and on the non-team front, it was remarkably active. I mean, we've invested this year, for us, we've invested $400 million in 2021, which was our most active year, which if you told me in the pandemic would have happened, I would not have believed you. I don't know if that was a result of people having more time at home to be able to really work, or there was some fundamental shift. But and the other thing is, we didn't see a lot of discounts. I mean, I can't sit there and say that we made acquisitions that were price-based because people had capital needs. We really bought quality companies that were more technology related, but still it was interesting that the amount for us, at least at Bruin, we were more active in year 6 than we were the 5 years put together. So I don't know what it portends for the future, but certainly this year has been an active year from our standpoint.
George, I'd agree with that. I think the areas around the teams in the leagues, for us at least, continue to be the most interesting places to invest capital from a return perspective. I had a thesis early on in the pandemic that because so many teams and leagues needed capital, all these investors were exposed to the sports asset class or content or IP asset class in ways that they hadn't previously. And, a couple of good deals happen and good exits, people tend to follow trends. And I think, as Mike alluded to, and Steve as well, I mean, I've seen a flood of new capital coming into the sector that historically, never even thought about investing in sports assets. So it's definitely going to get more competitive, but like always, I think the cream rises to the top.
Yeah, that's funny because I mean, Colin, that's had a pretty material, I think for everyone here, that's had a pretty material impact in a good way on all of our business, right? I mean, even let's say a year or two pre-pandemic, I mean, we closed 2 software deals in like early 18. And I remember, General Catalyst led one and Core Software led the other. And I remember thinking, what do those two have in common, right? They're purely financial returns focused and they're not sports endemic investors. And you kind of fast forward to where we are today. And I would say that's becoming more the norm than kind of the rarity. So it's like for the 5 of us, you sort of think about what's the market size or the TAM of investors out there that look in sports. And it feels to me like it's probably 5x over the last year or two and maybe 10x relative to 5 to 8 years ago, right? Is that fair?
I think that's right. And I sort of bucket the teams and the LP sales on one side, and the other assets that I think you're referring to, driven by this technology as sort of a leader of convergence across sports, entertainment, gaming. It's just creating a lot more opportunities. And those types of investors historically have played in those spaces and now see sports as just the next logical extension.
I just say for us, I think 7 of our 10 investors are not in sports. So to support that claim that there definitely are new people coming into the mix that have historically never invested in sports before.
Well, George, one of your larger LPs, CVC, I think maybe got their feet wet with Bruin, and boy, they're on a tear now across the globe looking at sports assets. So I think one of the changes that maybe has led to what Kyle said in terms of the volume of dollars looking, I won't say chasing, but looking at sports as an asset class, is that it really has emerged as an asset class. It's no longer the playground or the hobby of the uber wealthy, although you need to be uber wealthy to do it. But there's an economic financial thesis around investing in sports over time that's really held up through the Great Recession, through pandemic. You look at values, and you said there's no bargains, George. You look at some of the team transactions in the last 6 to 12 months, even on the LP side, and they're pretty fulsome valuations. And I think that speaks to the long-term growth and prospects of sports assets.
Is this a trend, guys, in periods of potential economic uncertainty or downturn? The Cubs sold back in 2008, kind of right in the heart of a very tough financial period. It was a record for an MLB team. Steve, you did the Mets deal 9 months ago, also in the middle of a very uncertain time. It was a new record for an MLB transaction. It feels like these periods are actually periods of big valuation growth in sports.
Yeah, go ahead. I mean, I'll just comment on the Cubs because we were involved with a losing bidder, the runner-up, which is never good in sports if you're on the buy side. But every other asset class was down 35%, as you recall, in that time frame, and the Cubs really held their value very, very well. And I think we've just seen that. So whether it's a trend or whether it's just the reality that when you look at the contractually obligated revenue that many of these sports teams have, a temporary 12 to 24 month downdraft doesn't affect the TV dollars that the league gets, the TV dollars that the team gets. Maybe gate fluctuates a little, but it tends to snap back. So it's been strong.
Yeah, and like having worked with Steve on with that bidder on the Cubs transaction, I recall that we're all surprised when the team sold for what was it, around $900 million, which at that point was a record price for a baseball franchise. I don't think it's necessarily though a trend that in a downturn that you're going to see these big values. I think it's more a reflection of the fact that these teams don't tend to trade hands that often, and when they do come up for sale, there's a unique opportunity to get in, and they just don't then see that type of valuation correction that you wind up seeing in the broader market. I do think that winds up making it and can make it an attractive investment for a lot of these funds that are looking to put capital in the teams, that they do retain their values through periods of economic uncertainty. Again, you brought up the Mets. Now that we see in the middle of a pandemic, the next MLB franchise going for an absolute record value. And going to the prior point, just around increased volume, the way I look at it is across the 4 major leagues in the U.S., it's an aggregate of $250 billion in total value across all the teams. It's pretty incredible that when you look at the overall returns that these teams have been able to drive for their investors, which are pretty significant, that is virtually untouched from an institutional capital perspective.
Yeah, I would just add the only difference between now and I think 20 years ago is in some of these leagues you can actually point to EBITDA as a way to value these companies. So not only are you benefiting from the scarcity dynamics that have always been there, but now these, as I think Steve alluded to, these are real, financial going concerns, not just supported by a rich owner.
Yeah, I feel like people forget that, like Mike, your point, the nature of the revenue streams that these teams have, right? Like if I'm an institutional investor, I love recurring revenue, right? That's why software and tech-enabled services get these huge multiples to top line. I don't think anyone's going to compare, an MLB team's growth profile to Snowflake, but you can argue there is sort of a financially sound case that the revenue streams and the long-term nature of that sort of justifies these multiples you're seeing, and at the worst provides you as a buyer a lot of downside protection, right?
Has the pandemic changed the risk at all here? I mean, obviously, as you guys know, outside of the NFL, a lot of sports teams don't make much money, and some, don't make any money during the year. They appreciate and have appreciated faster than the market has. But this last 18 months feel like a new kind of maybe downside risk for owning a sports franchise and the annual costs associated with this. Does that kind of creep into valuations or deals at all, or am I overthinking that?
Well, if you tell me we're going to have a pandemic every 5 years, the answer is yes. If you tell me we have a pandemic every 100 years, which is so far our history, I would say the answer is no. I think, the Mets transaction was an interesting one because as you noted, we sold the Mets right during the 2019-2020 timeframe. Pre-vaccine, we started it, closed it, right in that same time frame. And while it was a factor, I think people obviously wouldn't buy the team if you thought we'd be in a COVID pandemic for a decade. People look past it, and yes, there were adjustments based on the projected losses due to the pandemic for a year, or however one valued that. But then everyone assumed we would revert to the norm. And if you look at arenas and stadiums around the country, this fall, I think that's been proven out. I mean, there are packed ballparks and stadiums. People are dying to get back in there and watch their teams.
Steve, was there ever a time during that Met sale that you guys thought maybe we don't do this now? Maybe we see what the market looks like in a year?
Well, you always think about that in any transaction. I think we had in Steve Cohen, we knew he was the right buyer. He knew he was the right buyer. We were on course. There was a prior transaction at a higher price pre-pandemic that we adjusted downward. So I think we always thought we'd get to the finish line with Steve, and we did. So, had there been a more significant adjustment, we probably would have, put a hold on it, but there wasn't.
All of you guys, when you look at any deal, you're thinking about the future, what the risks are moving forward. On the point of this pandemic, is this a once in 100-year event? The way you think about the future, is this a once in a 10-year, once in a 20-year? How do you think about the idea of something like this happening again and having such a huge impact on entertainment?
I can just tell you the definition of material adverse change has become increasingly difficult to negotiate. Because I don't know what a MAC is anymore. I don't think of it as a once every 10-year thing, though. Hopefully, for all of our sake.
Clearly, the market doesn't think of it as a once in every 5 or 10-year thing, that it's a much longer term thing. You look at any type of live events business and the multiples that they're trading at today, clearly it's all based on a pretty rapid recovery in those businesses over the course of the next year or two.
And the leagues have gotten smarter too, right? Like you think back to financial crisis. The effectiveness of the league-wide facilities and the league's ability to sort of put mechanisms in place that smooth these kind of periods of uncertainty as you kind of look forward, it's impossible to predict what the next big bump in the road is, but it is easier to look at, okay, we have these structural things in place that sort of put all of us out in front of whatever that next not so great moment is, right?
I assume you're talking debt limits there, Kyle, but can you kind of be specific about what exactly leagues can do and what they have done in maybe the last 18 months
Yeah, I mean,
to smooth these transactions?
Yeah, sure. And everyone here can weigh in on this, but it's no secret the leagues have been pretty proactive in both upsizing and sort of optimizing the terms around their credit facilities. I think the leagues have also just, I would think, have become better with time at recognizing these very specific, unique moments in time where the teams need some assistance or need some leeway, if you will, on certain things. So I just think it's one of those things where it's unfortunate, but pandemic or financial crisis or next event, these kind of the leagues as governing bodies get better and better at helping their ownership groups kind of navigate that.
I just think the way that the industry held up in this very difficult time would give you more confidence should there be another challenge down the road. If you told me that you were going to have this kind of disruption and that these leagues and teams would come out of it as well as they have, really be kind of hard to believe at the beginning of the pandemic. I mean, it was an 18-month pandemic, and the leagues and teams fared amazingly well. The industry was amazingly resilient. I mean, you had the NBA finals on top of the hockey finals, on top of the Olympic trials, on top of Major League Baseball. You had a disjointed NBA season. I mean, the NFL had a great season last year. Their Super Bowl had a great storyline. So really, I think it was amazing how well the leagues held up through a very difficult time in a very affected industry. And this was a airline, hotel, cruise ship industry. And I think sports held up really well, which would suggest that for future challenges, it's probably going to hold up pretty well as well.
Another challenge. Oh, go ahead, Steve.
I was going to say the commissioners, often maligned, sure earned their salaries last year and continue to. I mean, it's not over yet. The challenges are still there, but I think in every case they did a great job.
You contrast it with Europe, by the way, and the lack of the league structure that we have here. You see a different story in many cases.
Explain that, Colin. Yeah, what do you mean by that?
Just the U.S. leagues, being more structured, as people alluded to, sort of collective entities that drive revenue at the league level and share it more equally versus, especially in football overseas. I think of teams more as sort of independent companies than as part of a league per se, and so don't necessarily have the same safety net as the U.S. teams did.
One of these changes that we have seen that leagues make is this push towards private equity. The NBA voted to change its rules. MLS voted to change its rules. Some other leagues, I don't think will be all that far behind. How does that, a lot of you guys also specialize in finding liquidity for teams. Does this make your job easier, these changes? Does this make your job harder? How does the change in private equity ownership rules affect your businesses?
Well, in general, at least historically, it's been really difficult to sell minority stakes in teams. And this obviously led to issues in the pandemic where teams needed to raise capital. That's one. You do have minority investors in teams that have struggled to get out at valuations that are comparable to controlled transactions. And then even teams that have been owned by families for generations, sometimes they've just wanted to take a little bit of capital off the table. But again, that's been difficult to do at really competitive valuations, and finding someone to come in and buy a significant stake has been hard. The idea of more increasing liquidity within the space, bringing more capital in, expanding the scope of investors that can come in, I think if anything, that's only going to lead to more transactions and making it easier. At the same time, it will increase some complexity, though. Having different types of investors in these businesses, and having to vet up these investors, making sure that the deal structures are aligned with how the league wants to think about it, making sure that you have the right controls in place. They're not easy questions to answer, and I think they've solved some of those problems with some of the initial deals that have happened. But I do think that's going to be an ongoing evolution going forward here.
I can give one recent example. We helped Inter Miami raise money from Ares about a month ago. We started that process in sort of July. We had 7 legitimate investment funds looking to do the deal. I mean, if you had told me that a year and a half ago in that time frame we'd have that much interest, I wouldn't believe you. So I think that is the direct result of everything Mike's saying. I guess it makes it easier, but you still got to find the right parties and negotiate the deals. And that was the first institutional investor in the MLS, and so we were working with the league to, frankly, set the ground rules in some cases.
If you guys were limited just to high net worth individuals for that, Colin, how different do you think that? How many people do you think would have been at that table? How different would that have gone?
Well, Miami is an interesting market. I'd say, sort of putting aside Miami specifics, broadly speaking, it's very challenging. Having done a few of these in the past, it can take over a year. And I think, as most of us on this call know, you never really know who's interested in a minority stake until you talk to them. And so that's turning over a lot of rocks to find people that are interested. But yeah, definitely not 2 months, I'll tell you that.
George, you guys, Bruin Capital, so far have not done deals into teams. Is it something you have looked at? Is it something that is not interesting to you? How do you think about Bruin's role in that ecosystem?
Yeah, it's probably not for us. We're more involved in cash flowing, positive EBITDA growing business. It's more of an asset play with a team. Not to say that there isn't cash flow and EBITDA with teams today, but we're more on the cash flow. And what we really invested in is technology. So if you look at all of our investments, we've become a really late stage technology investor, really taking great companies from outside the U.S. and bringing them into the U.S. And if you think of what the kind of returns you need for private equity, 15 to 25% IRR, you really need to be in those places that have that kind of growth potential and also those kinds of margins. So we've kind of naturally drifted into that space, and it's worked out real well for us. So I don't see that changing because, of course, we have liquidity needs, and so we're not going to be sitting around for 10 or 20 years hoping someday to realize liquidity. So with a shorter term window, I think that it probably doesn't make sense, for traditional private equity. Notwithstanding, there are those people that have developed financial instruments for the team market, but for what we do, probably not something we would be into.
I think of the private equity push as being a response to two things. One being the pandemic, obviously. The second being the fact that, and this is pre-pandemic also, the number of people that, as valuations skyrocket, the number of people that just have the net worth to buy a number of professional sports franchises in the country is getting smaller and smaller. How big a challenge is that part for you guys? That as the average NFL team reaches $2 billion, and same for all the other leagues going upwards, is it actually a real challenge now when majority stakes go up for sale that there is just a smaller pool of people that can even have those conversations to begin with?
I'm not sure for a control transaction we have an issue yet. It's on everybody's mind. And I say that because there's been so much wealth. I see Colin smiling. There's been so much wealth created in the last decade, or the last 24 months for that matter, that it's kept pace, frankly, with the escalation in prices. So for controlled transactions, what we would expect, for the next, foreseeable 2 or 3 or 4 years, that there are going to be plenty of buyers who, even at these prices, can write the check or put together a small group to write the check. The issue historically has been on, and is really exacerbated on the minority side, because if you own 10% of, pick any NBA team and you want to sell, you're talking about 200 million, someone writing a $200 million check for non-controlling, probably non-voting, no input, really good seats maybe, but you could buy the good seats or a suite. And that's a lot of money for those limited rights. You used to be able to buy a team for $200 million or be the controlling person. So that's where I think these PE funds coming in and that market developing. I think in 10 years, we're going to see tens of billions of dollars in, a plethora of vehicles specifically to capitalize on whatever small discount you get, whether it's a 10% or 15% discount off of the control price, to buy up these limited partnership stakes. A market will develop. That will make it easier to put a control deal together, because if you need to bring in an LP, you can say to him or her, don't worry, because there's all these funds out there. In 5 years, if you want to sell, or 10 years, there's buyers. So I think that's been the sea change. We all worry about, who's going to write a $5 billion check for some NFL team, and that's a limited pool. But there's still people out there who can do it, and as long as you have a couple of them in a process, you have a pretty fulsome process.
Since I don't have a dog in the fight in terms of the team side, it's a great investment. If you go back 20 years, there's no other industry I know that's had a double-digit CAGR in value increase over a 20-year period. Not to mention, we're not talking about the tax benefits for extremely wealthy individuals, and not to mention the platform the team has. And as everybody here points out, by bringing in either private equity or other financial investors, it's going to increase the value, because there's going to be more people willing to invest behind the teams than there used to be. As Steve points out, that'll help the limited partners, but it's also going to help the primary investor, because there's just going to be more liquidity, more demand, and there's a real scarcity of assets. So historically, not by what I'm saying today, but if you look back 20 years, there are very few businesses that have performed as well as the team valuations. And of course, it's a unique platform unlike anything else. And that's before, that double-digit CAGR is before the tax benefits that these people receive in investing in the team. So for all those reasons, it's a fantastic investment.
Yeah, the last piece, and I said it wasn't a hobby, and it's not, but there's no other business I know, unless you're a geek, maybe, computers would have the same appeal. Although I did have somebody tell me once that he was in love with Chuck Dolan's cable systems. I had never heard that before. But this is one of the few investments where there really is psychic income, is what I call it. I mean, there's nothing like, if you're into it, being the owner of a professional or major league sports team. Robert Kraft is a hugely successful businessman in his own right, but he wouldn't be Robert Kraft if he didn't own the New England Patriots. And I don't know what other business opportunities came his way in addition to the enjoyment of winning all those Super Bowls as a result of owning the Patriots. And you can go right down the line with every team owner that I know, and they get that psychic benefit on top of the financial return and the opportunities that George alluded to.
We only have a few minutes left, but we can end on this, and I want to get your thoughts on this. Kind of exactly what you're talking about here, Steve. We've seen sports teams become kind of platforms in their own right, and we've seen sports owners who own teams suddenly become, big in real estate or big in media. Do you see sports teams continuing to be kind of a vehicle for kind of opening doors and also presenting opportunities in totally different businesses once you own kind of the core central asset?
I think,
yes, but I'll let Mike amplify.
I'll just say quickly, like, I think you've seen across industries, look at Disney. When you own the core IP and you find various ways to monetize that IP, there's a lot of different avenues. You can go direct to consumer. You look at the gambling opportunity. You look at the ancillary real estate opportunities. I actually think that there's, in addition to a lot of all the tailwinds that we've talked about with institutional capital coming in and the impact that can have on valuations, you then factor in that there's all these other mega trends that that are also progressing, and it's all happening at the same time. I actually think that sets up really well for this asset class to do well going forward. And look, we've seen this play out a lot of different ways across different industries, but I still think that we're in the early innings of that when it comes to sports teams, and there's a lot of potential synergy to be driven there.
Yeah, the direct to consumer part is the key part, right? Like I think it's easy to take for granted. Even 5-8 years ago, and teams were still figuring out, how do I actually understand who's coming into my stadium and who's consuming my content? And teams are getting pretty good at that now. So you're sort of seeing this flip where teams now kind of own the fan relationship in a way they never had. And then that leads to all the things Mike talked about, where you can now kind of monetize and deepen that relationship with the fan through, ancillary content and gaming and all these things that happen in the ecosystem outside of the stadium or the arena, right?
I mean, notionally, where this is headed is the lifetime value of a consumer.
Yeah.
And the share of wallet that a franchise has in that area is going to be far in excess of anything else out there. So I think, we do a lot of direct to consumer work with a lot of leagues and federations around the world. And we're really trying to look at people. It's not what you charge, it's your share of mind of that consumer. And sports is going to be a big part of that going forward. And that'll be a big part of the financial ecosystem in the next 10 or 15 years, in my opinion. So while the audience might shrink a little bit because the way things get distributed might change, the engagement with that consumer and the value of that engagement will be unmatched from a team or league standpoint, in my opinion.
Yeah, I'll emphasize George's point on LTV and maybe draw a parallel to some of the SaaS world that Kyle was alluding to. One of the most important metrics is retention, right? Sports teams do a pretty good job of retaining their fans. I mean, I've been a Jets fan for, I guess, 35 plus years now, and haven't seen very many wins, and I'm still a fan. So it's a pretty good dynamic if you're a team owner these days.
All right. Well, guys, we will leave it there. Colin, Kyle, George, Steve, Mike, thank you for joining us.
Thank you.
Thank you.
Thank you.
Appreciate it.